so as I mentioned, we're learning about something called the balanced scorecard. How many people are familiar with that term, balanced scorecard? Okay. And other ways to measure performance. And as I mentioned earlier, some of those are not financial, they're not quantitative. There are other ways to measure performance that we get into in managerial accounting. What are the characteristics of an effective performance measurement? So think about it, what's the whole point, right? The whole point is to see how you're doing as an organization, to see how individual departments or subsidiaries or divisions are doing, and to see how individuals are doing in their roles, right? You have to be able to somehow measure their performance. How do you do that? Not that easy. For some of the financial aspects, we can use tools like ROI and residual income, both of which we used last week. As I mentioned earlier, we will also learn about EVA, which is kind of similar to residual income. We will also learn this balanced scorecard approach, and companies that use that are aware or of the opinion, I can say, I don't want to sound biased, they are of the opinion that if you only measure financial performance, it's going to drive a certain type of organization and certain types of actions that are not always in the best interest of the company. It probably told you the Ford Pinto story, how Ford was so focused on making a profit from the Pinto. They knew it was going to kill people, but they made it anyways because they were focused on profits, right? So organizations that realize that too much focus on profit can actually be not only irresponsible, it can actually be bad for business. And so they use this balanced scorecard approach to look beyond the financial. So that the financial performance is only one of 4 ways that they measure the overall performance of the company. So we'll get to what those are. All right, so as it says here, performance measurement is used to motivate managers to make decisions that benefit the corporation. Why do we go to work? Mostly for a paycheck, right? We need to be honest, right? If they didn't pay you, you'd probably stop going. We want to do work that we love and that provides some value to humanity. And if it does that, that's great. But because we live in a society where you kind of need an income for survival, that's typically first priority for people, right? So if the organization says, our objective is to expand the company into new geographic markets, or our objective is to serve humanity, or our objective is to come up with new products. Sure, that sounds great. That's something you can support. But in the back of your mind, you're thinking, show me the money. Where's my paycheck? Do I get a promotion? Are you going to pay me more? Right? And it's not anything bad. It's just that's the way our system is built. So how does the company then get these employees to do what the company wants? Right? Not just what's good for the employee, and you get that person to do what's good for the company. And this is where goal congruence comes in. I think, is that up here somewhere? Maybe it's on a future slide. Goal congruence means creating goals for the manager or the employee that are also going to benefit the company. It's a win-win arrangement. So maybe your boss says to you, hey, if you can increase your production by 10%, you'll get a bonus. It's good for the company. You get more product produced. It's good for you. You get more money. Right? So there's goal congruence. Which then means they have to measure your performance. They have to know how much you were producing before and how much you're producing now. So they can see if you improved and then reward you appropriately. So that's really what this whole chapter is about. Goals have to be realistic. What happens if your manager says, I want you to double your production? Probably not going to happen, right? Unless you were like slacking off and really not trying, then maybe you could double your production. But if you were already trying to do a decent job and now you're being expected to work twice as fast, even if you could, chances of mistakes, chances of accidents, chances of burnout all increase pretty significantly, right? So goals really should be realistic. It should be something the employee does feel that they can attain. In fact, I don't know if you remember goal setting theory from Intro to Business, but that theory says you want to set goals that are challenging enough that it's motivating for the employee, but not too challenging that they get frustrated. And you don't want to be evaluated on things you don't have control over. If your boss says, I want you to increase your production 10%, but he doesn't give you the materials you need to make more products, that's not your fault, right? And that would be frustrating. You don't get the bonus because of something you couldn't control. So these are some of the, the ground rules for performance measurement. Make sure you're measuring something that's important to measure, that you're incentivizing people in a way that's going to get them to do what the company wants them to do. Sometimes employees will find ways to get the incentive in a way that doesn't really help the company. They'll cheat this, they'll game the system. Like I used to work in a call center for AT&T Wireless, and there were ways you could make your call statistics look better. You could accidentally disconnect a customer. And guess what? That makes your average call time shorter. And it allows you to take more calls because you keep hanging up on people. Your stats look better, and maybe you then get a raise or a promotion or something because you're such a good, call center rep, but really you're cheating the system. So how do you create a system that really measures what you want it to measure, gives the appropriate incentive, is not too challenging, but it's challenging enough? It's not that easy. It takes practice, some trial and error sometimes. All right, so we talked last week about responsibility accounting, right? Where you have to decide for this portion of the organization, what is it responsible for? Is it responsible for revenues? Is that really all we care about for this particular telemarketing department? Is it responsible both for revenues and costs? What do we call that type of responsibility center? They're responsible for revenues and costs. Profit center, right? Do they not have any ability to generate revenues, and then they're just a cost center? By the way, if you work in a cost center, like the call center I was in was a cost center, we always got we didn't get the best treatment in the organization. The salespeople got the best treatment because they were bringing in the revenue, right? So cost centers often get kind of looked down upon. Or an investment center, where you are a profit center, but you're allowed to also invest company assets and grow your organization, right? So that's what we talked about last week. Let's see, some of the company goals. These are things that might be important to the company. Increasing market share. In other words, if you used to have, let's say, the total possible customer base for this particular product, you used to have 10% of those customers, and your competitors had 90%. And then you increase your market share from 10% to 15%. That would be an increase in the share of the market. increasing revenues, decreasing costs. Both of those help your profits, right? Revenues go up, costs go down. And decreasing defects so that when you're producing products, more of them are acceptable. They meet the quality standards. That saves the company money and also leads to better customer satisfaction. They get a quality product instead of a defect. But those are the company priorities, right? What are some things that manager goals might be based on? And the manager wants maybe a promotion, because promotions come with more pay, right? Usually. Maybe they want a raise. They don't want the extra responsibility, they just want more money. Or a bonus, or stock, or they want to work remotely, right? These are things that might be important to the individual manager. So then how do you come up with a reward system and a performance measurement system that helps the manager meet their goals while helping the company meet its goals? So you're evaluating the manager, right? Are they doing a good job? Are they meeting those revenue targets, those profit targets, whatever? And you do that by monitoring what they're doing, looking at their accounting reports that are being produced about their department, observing their behavior, getting feedback from customers, employees, and others. And the manager's actions hopefully support the goals that you set out for them. Usually with their input, right? You want to hear what they think their goals should be. Sometimes if you think they should increase production by 10%, maybe they think they can increase it by 20%. Okay? Give it a shot. Let's see. Let's see if you can do it. And the goals should support the organizational strategy. So you have this cascading effect, right? The strategy is the long-term plan for the organization. The goals for the organization are how it's going to accomplish the strategy. And for the manager, the goals are how they're going to advance in their career, which dictate their actions and then get evaluated. So a good performance management system should increase retention and loyalty, right? Do it right. People will stay with your organization longer and they'll work harder. If you put in a performance measurement system and you find everybody's griping, they feel like it's unfair, they're quitting, okay, oops, it backfired. That's not what we want. We want the opposite of that, right? But that can happen. You also want increased communication. You don't want to set up a situation where now the operations department is keeping secrets from the marketing department. They view each other as enemies instead of collaborators, right? You don't want that. You want them to collaborate, work together. You want people to share information and all be working towards that common strategy for the organization. Even though each department has its own goals, still the collective goals for the company should be something everybody supports. You want to see increased productivity, typically. Sometimes that means automation. There's a better way to do things with AI or robots or software. Maybe you switch to that. That might mean you've got employees that you don't need them to do their old job anymore. They have to think, well, what do we do with these folks? If we lay them off, that can have a negative impact on the rest of the organization, right? Not to mention the negative impact on those laid off employees. So maybe can we transition these workers into different projects or different departments? Or can we offer them maybe an early retirement? Maybe they were thinking of retiring early. what do we do with these folks? But in general, companies are always looking for ways to be more productive. Can we be more efficient? Can we bring costs down? Reduce waste? Reduce pollution? Right? So hopefully your performance measurement system helps do that. And then hopefully increase job satisfaction, which ties back into the retention and loyalty. Being a great leader, a great manager is not easy. It's really, if you get promoted, it's really easy to think, oh, I've got all the best ideas, I'm going to solve all these problems. And then you get in there and you're like, oh, wow, these are people I'm dealing with. They all have different perspectives and different values. And I can't make everybody happy, right? So how do you pull something like this off? We'll talk about some of the performance measurements that you can use, things like the balanced scorecard and others. But I think regardless of what specific tools you use, a key part making a company successful, keeping it successful, I'm going to go out on a limb. I'm going to say it's humility. I think it's for the leaders to realize they don't have all the answers. They need to be talking to people at all levels of the organization, all departments, even people that are not employees, customers, suppliers. Listen to their feedback, especially the complainers. Because the complainers are telling you something you need to hear that maybe 100 other people didn't have the courage or just didn't care enough to share that complaint with you. But if you listen, you might not 100% agree with this person's complaining about, but there might be something there that you say, okay, that's a good point. So being able to factor in multiple perspectives, create a sense of teamwork, so that, let's say you're the CEO, you realize you might have the final say, but try to make sure that if you're making the final decision on something, it's because you consulted everybody that had a relevant perspective. And they all contributed to the solution. The companies I've seen that have been really successful, it's because they've got that kind of teamwork environment. And the CEO realizes they don't have all the answers. Are there any questions or comments so far? All right. Okay, so as it says here, accounting-based measures are easy to use. God bless you. That's what we've been learning about. How do you crunch the numbers and measure sales and revenue and costs and things like that, right? But it's not always the best or the only way to measure performance. As I mentioned with the Ford Pinto, focusing too much on just the financials can lead to some very bad decisions in some cases. Here's an interesting point. Some management decisions affect multiple periods. How often do corporations publish their financial statements?
Periodically.
There is an annual, also quarterly. They're required to publish quarterly financial statements and an annual report. That means every 3 months, they are sharing with the world how that corporation is doing. The investors and the analysts watch for that and they look for trends. If you took my financial accounting class, actually I think any financial accounting class at Hartnell, you did a course project where you analyzed publicly traded corporations' performance over 4 years. So corporations have this 3-month mindset. how much profit can we make in the next 3 months? Because that's when the investors are going to be looking at our financial statements and buying or selling our stock. And we want to try to get that stock price up, right? In the corporate world, it's all about the stock price. The higher your stock price, the more money you can raise when you issue stock. But also the executives are compensated usually by stock. So when they push up the stock price, they become wealthier. So there's this whole system that revolves around these 3-month financial statements. Do we sometimes need to plan out more than 3 months in the future? Yeah, corporations really need to be thinking years into the future. But if your whole incentive system is built around bonuses every 3 months, if you meet certain targets, that creates a short-term mentality, right? So how do you do that? How do you drive that short-term result while also leading to some long-term objectives? Not that easy. Okay, this is an interesting example. We've got 2 managers, A and B, and they both buy 500,000 units of something. Manager A started purchasing in August. Now, the price of what they were purchasing was going up. You see, in fact, pretty quickly, went up from $9 to $14 just between August and December. Kind of an extreme example, but it helps highlight how one wrong decision can have really big impacts. Manager B did not purchase anything in August. They waited for whatever reason. Maybe they had a good reason. But they waited, they missed that opportunity to buy at $9. Now they did start buying at the same time as A in September, and then they stayed on track with A. But A was already done December 1st. B had to still make one more purchase, and by now the price was up to $14 per unit. They missed that $9 opportunity. They ended up buying at $14, 100,000 units. That's a difference of $5 per unit times 100,000 units. It's a $500,000 mistake, right? Just because they waited. If you were the boss of these 2 people, what would you do to prevent that kind of mistake from happening again? Tyra?
We follow manager A's train of thought.
Okay. Okay. Yeah, maybe say, hey, if we know we need to make a purchase and we know prices are going up, the sooner the better, right? Now, we don't have a lot of details here, but I think having a conversation with A, what led you to make that purchase in August, and maybe having a conversation with B. Why did you decide not to make a purchase in August? Maybe they had a perfectly valid reason, right? We don't know. But we can learn from the experience and then maybe create a policy or a procedure. Maybe build it into a system, maybe have the software remind everybody, hey, get your purchases in now. Maybe use AI to tell us when I don't know. Right? There could be multiple ways to approach it, but we definitely know we don't want this mistake to happen again. So we can learn from it and try to find a solution. Okay, imagine a dentist's office. Okay, let's discuss this question first. What types of goals might a dental practice have? Okay, so number of patients that they see. What was that? Okay, opening up more locations, expanding to more locations. What else?
Getting better.
Better equipment. I once worked for the staffing company, and the owner of the staffing company decided he was going to branch off into dental tools. I'm like, what do you know about dental tools? He was able to buy some from somewhere in Eastern Europe, some dental tools. I'm like, I'm not getting involved in this. I don't know anything about that. It didn't really work out. But what about accuracy? Could that be? Making sure we're doing the right procedure on the right patient. Minimize repeat visits where they have to come back because their bite isn't right or something. Have goals related to being able to process the insurance quickly, right? There are many types of goals we might have. So some are more operational, some are more financial. So how can we motivate the staff? If the staff include a receptionist, some dental assistants, and dental hygienists, how might we keep them motivated?
Money.
Is that bonuses? Bonuses, money, what else?
Scheduling. Price.
Say a lot of
Scheduling.
scheduling. Okay. Okay, so money can be a motivator, kind of. If you might remember from Intro to Business, especially if you took it with me, it's a complicated motivator, and it doesn't always motivate people. It kind of depends on the situation. However,
Benefits from the business, so just say the employee returns of
Yeah.
more of a discount.
exactly. So maybe you get dental treatment at a discount or for free. These could be incentives. I think where it gets a little cloudy is what we mean by motivation. Because motivation does not necessarily mean happiness or being joyful or being glad about something. What motivation means is getting people to want to do a better job. When we're talking about management, workplaces, that's what we mean by motivation. So yeah, you can offer them a bonus. The money itself is something they'll be glad to receive, right? Nobody's gonna turn it down. Everybody could use extra money. Even billionaires think they need extra money, right? But the question is it gonna cause them to behave differently?
No.
It might, huh?
Maybe providing some type of training and study on.
Yeah, okay. Training can boost somebody's confidence. Now, sometimes employees don't like to go to training. They're like, oh, I have to watch this training video. And some training videos or training programs are really bad, right? But if it's done right, it can increase self-confidence, gives them something they can put on their resume for the future, might help them just do a better job. So yeah, training can be very motivating for some people. So just like this whole chapter where there are financial aspects and non-financial aspects, same thing when it comes to motivation. We can use money as kind of that carrot to dangle out there and get people to do things, but then they might be doing it only for the money, right? How can you get people to want to do a better job? The work environment? Okay, creating a culture. Creating an environment where they actually enjoy coming to work. They enjoy talking to the patients, to the dentist, right? Praise. People generally like to be recognized if they've done a good job. Some people don't like to be recognized publicly, so you have to keep that in mind, but at least privately to be able to say, hey, I really like the way you took care of that patient. That can be very effective. And it's non-financial, right? Okay, so we talked about some ways to motivate them. We did get into some rewards. There could be monetary rewards and non-monetary rewards, but it's kind of interesting when I asked about motivation, some of the answers went directly to the rewards, right? And the rewards can be useful tools to motivate people, but they're separate. Some people are just self-motivated. Okay, yeah, here's a situation. I know there's a lot of text, don't have to read it. You've got an order from a customer that you really care about. You really want to get this order done quickly. And you know there are other orders ahead of yours. So you go to the production manager and you say, hey, can you expedite my order because it's really important? Did they do it? Depends. Depends is a good answer.
I like a business account and business.
Yeah, maybe if it's a really valuable customer or a customer that's on the verge of leaving you to a competitor, yeah, maybe you do expedite it. But then you have to, consider the consequences too. If you expedite it, you are slowing down the other orders. And you're also creating a pattern where if you ask for this today, you might come back and ask for it again tomorrow, right?
Or the customer might think that they can keep
Exactly. That's true.
So things have to be done.
You're creating an expectation with the customer.
I have to let the go up.
Mm.
First, and then asking
Yep.
what-
Yep. That's right. So that's one of those organizational decisions. How much do we want to bend over backwards to help our customers versus say we have boundaries, we have limits. Okay. All right. So some of this we've talked about already. A performance measurement system should really evaluate the things the manager can control. No point in evaluating something that somebody cannot control. We should we should evaluate things that are measurable. That doesn't necessarily have to mean that they're quantifiable though. If you in your career, you go on to a master's or a doctorate, you'll probably be doing a lot more research and you'll learn about how there's a lot of research out there that's qualitative in nature, not quantitative. For example, how did your customer feel from that experience? You can't quantify a feeling. You can find out about it, you can document it. And then if you have enough information from enough customers, then you can turn it into something quantifiable. But the feeling itself, that's qualitative, right? And that's still a measurement. It's just not a numerical measurement. Your performance management system should be timely. If people are getting feedback, and this has happened to me, and I'm sure other people as well, you're getting feedback on something that happened maybe a year ago. And you're like, why are you even bothering to tell me this now? Why didn't you tell me this like 10 or 11 months ago? Right? Should be consistent. What happens if the way you evaluate, is that what I said? If the way you evaluate one manager is not consistent with how you evaluate a different manager? Could lead to a lawsuit, or at least disgruntled managers. If they feel, this goes to equity theory, if you remember that from Intro to Business, if they feel that they are being treated unfairly, that can negatively impact their performance, which again is not what you want, right? Now that doesn't mean that every manager is evaluated exactly the same. Obviously your sales manager and your production manager, you're going to evaluate differently. But if you've got two sales managers that have a very similar job, and one of them you're evaluating based on last month's performance. And the other one, you're looking at the last 6 months of their performance. And they share that information, right? That might seem inconsistent and unfair. All right. We've learned about standards, right? Remember the standards and variances chapter? We learned about budgets. We had a whole chapter on budgets. And these are how we evaluate performance, right? Budgets are projecting for the future. And then once it happens, you have your actual, you compare it to the budget. Standards are what we've said are the expectations. And then you look at the actual performance and compare it to those standards, right? So that's a big part of the performance measurement process. So some goals of companies, let's see, evaluate an operating segment or project using ROI, residual income, and EVA. Okay, so these are financial, right? And we're already familiar with ROI and residual income. The way we're going to apply them in this chapter, you'll see there are some differences. Sometimes the terminology is different, but it's the same basic formula and concept. And these financial measurements are all about profits, right? Why do companies want profits?
Business has to keep running.
Say louder.
The business has to keep running.
Okay, business has to keep running, so you need to have enough money to keep it operating. If there's extra money, you can reinvest. You can grow. You can even just put some money aside for emergencies. You can pay out dividends to your stockholders. You can pay off debts. So profits are important, right? They really are. If you're not making a profit, you might not be able to sustain your business. So as far as reinvesting the profits, you can buy more assets, equipment, vehicles, and things like that. You can do research and development, maybe come up with some new products, acquire other companies, advertise. All of those require that you have enough money, right, to do those things. All right, so ROI. I think I explained it to you. It's your return divided by your investment, right? And the return is some type of profit. Could be your net income, could be your operating income. Kind of depends on the situation, but it's some kind of return. And you divide it by whatever you had to invest to get that. And it gives you a percentage. Well, as I mentioned here, the terminology is a little different. Instead of return, they're just calling it income. Again, could be net income, could be operating income. And they're dividing it by average capital assets. And what does that have to do with investment? If you buy equipment, those are assets. You're investing in your company. You buy a factory, or you build a factory, an asset, right? And it's an investment in your company. So even though before I told you return divided by investment, in this chapter, they're calling it income divided by average capital assets. And by average, they're just saying for that period of time, what's the average capital assets, so fixed assets. We're not talking about short-term current assets, we're talking about fixed assets. What is the average amount of these capital assets that you have for that period of time? As it says here, capital assets can be tangible and intangible. They have lives longer than a year, and they're also called fixed assets. Same formula, same idea, just the wording is a little different. Now, this is a new concept we haven't talked about. You can take that same formula, return on investment. And remember, from this slide, it was income divided by average capital assets, right? Notice we have income here. We have average capital assets here. So basically, we're taking that formula and sticking something else right in the middle, sales revenue. It's the denominator here, it's the numerator here. So this gives us an additional insight into what's going on. It gives us sales margin. When we take the income, return, profit, whatever else you want to think of it as, but we take that income and divide it by our sales revenue, tells us how much profit is generated for each dollar of sales. That's good to know. I mean, yes, you want to sell as much as possible, but if you're not making much of a profit, what's it worth? So in addition to how much you sell, it's how much profit are we generating out of those sales, and that's what it tells you here. If we take the sales revenue and we divide it by average capital assets, that's our asset turnover. So what is the relationship between how much we're selling and the assets we're investing to get those sales? So we've basically taken our ROI formula and split it into these two halves. Sales margin, asset turnover. And then mathematically, if you multiply your sales margin by your asset turnover, you get your ROI. That kind of shows you here. Remember, the ROI was income divided by your average capital assets, right here. Income divided by average capital assets. What is your income? Well, the net income is revenue minus expenses, right? It could be other types of income, but that would be one for an example. And average capital assets is your capital assets at the beginning of the year plus your capital assets at the end of the year, and then you divide by 2. So to get your ROI, calculate your income, divide it by your average capital assets. If you want to break it into these subcomponents, income divided by sales revenue gives you sales margin. Sales revenue divided by average capital asset gives you asset turnover. You multiply sales margin by asset turnover, gets you back to ROI. That's the relationship of these formulas. Christina? It's the profit, some sort of profit that your company is making. Could be net income or operating income or others. We'll see other examples as well. Okay, so this is taking that ROI concept and just adding another dimension to it. Any questions on this concept? Okay, here we've got bakery with 3 divisions: donut, bagel, brownie. We can see the income for each one. That's their profits. We can see their sales revenue. And we can see their assets at the beginning of the year, assets at the end of the year. That's all the information we would need to calculate ROI. And then to also, take it to the next step and incorporate sales revenue into our measurements. But before we do that, just looking at these, how are these divisions doing? How's the donut division doing? $1 million of profit. It's good. Out of 5 million in sales. They had to invest a little under $3 million to get that return. Now that investment, will last multiple years, right? It's not like they are expecting to get it all back in 1 year. How about the bagel division? They've got a much higher income, right? Much higher sales revenue, also higher assets being invested. Brownie division, I guess they're closer to the donut division in terms of their income. Sales revenue is pretty close. Their assets are a lot higher though. They're having to invest a lot more assets to get the same amount of profit. So it gives you a different perspective on what's happening. So we won't go through all of this, but let's take a look. Start with ROI. Or I'll tell you what, let's go to the Brownie division. So if you take their income divided by the average capital assets, 27%. How does that compare with the other two divisions? Low, right? Here we see 35% and here 42%. That means the other divisions are doing a much better job of taking their investment and turning it into profit. Let's break it down further. Let's look at the sales margin for the Brownie division. All right, so this was their profit, and then this was their sales. Or income, I'll say income to be consistent. This was their income, that was their sales revenue. So they have a 24% sales margin. That's better than the donut division, not as good as the bagel division, right? So they're doing okay there. How about asset turnover? Looks like that's where their problem is. Because you see their asset turnover is 1.14 compared to 1.43 and 1.75. How is that asset turnover calculated? Exactly. Sales revenue divided by average capital assets. So if we go to that step, doing that calculation, it gives us a perspective and we kind of see where their problem is. Gordon.
With these calculations, I'm going to do anything similar to what we did with the standards and the variances. How we would kind of use that to go back and forth with the different companies and like swapping them out. This seems similar.
Don't remind me. that chapter still makes my head hurt. Not so much. Not so much. This is going to be a much lighter chapter. We'll do some comparisons here and there. There is one problem that's really challenging, but we'll go through that together. I'll explain it to you. So it's just sort of adding a new dimension to some of the calculations we've done in the past. Okay, and then that average capital assets, where does that come from? So again, you take the beginning capital assets, the fixed assets if you prefer, plus the ending capital assets and divide by 2. So if you were an executive overseeing these 3 divisions, how might this information be useful to you? What action might you take? Or what concern might you have?
For the Brownie division, the probably listen to a different division instead of the rules or the things.
A little bit louder, Jared.
So instead of focusing on the Brownie, they put that efforts more into the other 2 divisions and doing better.
Oh, okay. Yeah, so definitely if you're going to be adding more assets, you might want to do it where you're getting, better return. Obviously, the Brownie division is not doing as well, so you're not you're not gonna just throw more money at the problem. But you might wanna try to see if there's some solution. Maybe talking to whoever's in charge of this division and trying to figure out why does it take this much in assets to get those results? Some way you do it with fewer assets, or is there some way to get better results with the assets you already have? And if there's not, then maybe, maybe you just don't need the Brownie division anymore. Maybe we just get rid of it. But at least it lets us see where the problem is. The amount of assets being used to generate this amount of sales, to generate this amount of profit. Oh yeah, and then remember, you can take the sales margin, multiply it by your asset turnover, and it gives you your ROI. That's what we see here. Sales margin times asset turnover equals ROI. If there's a target ROI of 30%, meaning that's what we expect for every division. We look at the Brownie division with 27%. Sorry, you're not meeting that expectation, right? We need to do something. Oh, this is, yeah, so fixed assets depreciate, right? Capital assets get capitalized, which means they get depreciated. Even intangible assets get amortized. So that's another form of capitalizing the asset. When we do that, that lowers the book value of the asset, which then increases our ROI. Because as your asset value goes down, mathematically, you get a higher ROI. So that's something to keep in mind as well. Like here's an example of that. If original average capital assets are this, and then they go down by $500,000 at the end of the year because of depreciation. Just from that depreciation, you end up getting a lower average. And that lower average gives you a higher ROI compared to the original. Okay. Let's look at these two investment opportunities. Let's imagine we can only do one or the other. Right? The first one has a 50% ROI. Second one has a 27% ROI. If we made our decision solely based on ROI, we would go with the first one. But would that really be the best choice? Or should we consider something else? Okay. So what else would we look at other than ROI? Okay. So in the first opportunity, we only have to invest $1,000 of assets, but we only generate $500 of income. Got a great ROI, but it's just not that much money. And we're giving up the opportunity to do the other one. With the other one, it's a much bigger investment, but if that's going to generate $20,000 a year, it's going to pay itself back in what, less than 4 years?
You can see how much an opportunity went for 75,000.
Yeah. So would you go with number 2, Joe?
Well, I would want to play like the top of my 75,000.
Oh, if you could do the top one 75 times?
Yeah.
That's a good idea. If you could, yeah. Yeah, that's thinking outside the box. Oh, okay. So here we have a problem. This is an interesting one. Yeah, I guess I'll bring up the problem set here. Oh yeah. Oops. Making things. Okay. This is the chapter 12 problem sets and problem 7, I think it said, right? Oh, No, there aren't seven. All right. Oh, problem two. There are only 6 problems in this problem set. We're going to do 4 of them together. Okay, so this company, it's an electronics manufacturer, and they can only produce one of these 2 possible products. Their first option, it's this industrial motherboard. That's, a computer board with chips, computer chips on it. It has a 75% probability of making $1 million profit. However, there's a 25% probability it only makes a profit of 150,000. The second option, a regular motherboard, they feel is guaranteed to make a profit of 710,000. Now, the manager of the production department here, Florentino, he gets a 20% bonus based on the profits of his department. And he is a risk taker. Which would he choose? He would choose A, right? Because he's got his eyes on that $1 million. And because he's a risk taker, he's thinking, yeah, we might not make $1 million, but if we do, that's going to be a much bigger bonus for me than if we only go with the safer route, even though that would be a pretty good bonus too. So he would choose the industrial motherboard. Now, top management is more conservative. So what would they likely choose? B, yeah. Hey, anytime you think you're guaranteed, well, first of all, if you think you're guaranteed something in business, you're wrong. There's no guarantee. But if you're highly confident that you're going to make this profit of 710,000, why take the chance you might make only 150 with the other option, right? Might as well play it safe if you're conservative like these folks are. So they would go with the motherboard. But here's the real question. How could they change Florentino's compensation so that he doesn't take unnecessary risks? Make it less about profit? Okay, so go ahead, Christina. Same profit for both options? Okay. So you get a certain bonus either way, maybe as long as you make a certain minimum profit, then you get a set bonus instead of a percentage. I could do it. Okay, that could be a good approach. So we could say flat bonus based on meeting certain targets. Mr. William? Yep.
I'm still trying to do the math for this, but I see the probability that the first one would make 710,000 or more.
Mm-hmm. Well, it's got a pretty good chance of it, right?
Yeah, I think it'd be 7%. I'm not sure if that's great.
Okay.
Okay, actually, the number.
What else might you do with Florentino's compensation? To help decrease his incentive to take these big risks. Decrease the bonus. Okay, he's probably not going to be real happy about that. So maybe instead of 20%, he only gets 5 or 10%. So you could lower the bonus percentage. If you were going to do that, what else could you do so that he wouldn't be upset? Gina? base a percentage on the profit, but that's what we started with, right? So if we lower the percentage, he's gonna get less money. Unless maybe we raise his salary. You make the bonus based on other things. It's true.
Because I mean, that's all one part of the job.
Mhm. Okay, exactly. So we might find other things to evaluate him on besides profit. Is it beside or besides? Beside? Besides. Besides, okay. Yeah. So there's no one right answer here, but we have to somehow alter his compensation model so he's not so incentivized to take big risks. And to do it in a way where he's still going to be happy with his compensation. Any other comments on this one?
Make it the bonus discount credit is required.
So he has to wait longer to get the bonus?
Yeah.
You could, yeah. But again, he's not going to be real keen on that. So if you're going to do that, you might need to find some other way to keep him happy.
You could have the bonus, well, either you could just increase it to 20% of the 1 million, that'd be a lot, or you could cap it at 20% of 710,000.
Okay. Yeah, if he had a maximum bonus of say 140,000, right?
It would be around there.
Then he'd probably go with the safer option. That's a good idea.
Actually, utility.
So I'll put instead of lower bonus or capped bonus. Okay. Let's see what's next here. Residual income. Okay. Okay, I'm going to stay over here behind the computer because coming up is this very complex problem that I've tried to simplify for us, but we'll get there in just a moment. So you probably hopefully remember residual income from last week, right? Where basically just take the income and subtract the investment times the cost of capital and see what's left over, what's the residual income. And then as long as it's a positive number, it's an acceptable option. Well, here again, the terminology has changed a little bit. It's still really the same concept. Instead of the profit or income, it's project profit. So your residual income is your project profit minus your investment. Here they're calling it project invested capital, but it's your investment. And then instead of times the cost of capital, here it's called the minimum required rate of return. Which is actually a little different. The cost of capital is what it actually costs you to borrow money or issue stock. Whereas minimum required rate of return is a number your company came up with and saying, this is the minimum we require on any investment, minimum percentage return that we want. So very similar to what we've done, just terminology is a little different. Here's an example. The donut division of that bakery that we saw earlier is going to buy some new machinery for $1.5 million. So that is the investment, right? The expected profit is $250,000. So you can call that return, income, project profit, whatever you want. And the company has a required minimum rate of return on their projects of 18%. So if we apply this formula, we take the expected profits here, minus the investment times that required minimum rate of return. In this case, it comes out to a negative number. Is that right? Let me double check it. I'm sure it's right, but we've got time, so let's see. Yep, it is. It's negative $20,000. So that would mean that if we do this project, even though we're going to have a profit of $250,000, the residual income is $20,000 lower than our threshold, based on what we are saying is the required rate of return. If we had a lower required rate of return, then maybe it would be an acceptable option for us. But based on this current required rate of return, we got a negative number. So we should not do this project. Okay. So here is an example of residual income. Now I've color coded this one. It took me, I've got access to the answers, right? Even with the answers on this one, I still couldn't understand what was going on. I had to spend quite a bit of time going over it, and I finally figured it out. So I color coded it so it makes sense. So let me walk you through it. This is problem 4. In fact, I think what we'll do, I'll toggle back and forth between this color-coded version and then how we'll actually fill in the answers on the problem set. Okay, so this is a hospital, and they have an after-tax income of $7 million. So right off the bat, they're giving us after-tax information. All of these formulas we've dealt with have been pre-tax. Like where it talked about this profit, doesn't say anything about taxes, right? So for us to use this formula, we have to convert an after-tax income into a pre-tax income. Okay, so that's one issue. We'll cross that barrier. Another thing, they say the hospital has assets of $70 million, okay? And then they have non-interest bearing current liabilities of 22.8 million. Non-interest bearing current liabilities. What are they talking about? What they're talking about is things like accounts payable. It's a current liability with no interest. Oh, why didn't you say that? Why didn't you just say they have accounts payable and other current liabilities of 22.8 million? But they phrased it that way. So, okay. It makes sense now. So they have total assets of 70 million with current liabilities of 22.8 million. Okay, well, why do we care about that? The reason is current liabilities are used to purchase current assets. So if we subtract this 22.8 million from the total assets, that gives us an idea of what their fixed assets would be. And they do give us a required rate of return. And then they ask us to figure out residual income. Okay. So the green part. First, we have to convert that after-tax profit that they gave us to pre-tax profit. They said the after-tax profit is 7 million. But they also said the tax rate is 30%. So what we do is we take $7 million, divide it by 70%, and that gives us the pre-tax profit. So who can tell me why would we be dividing by 70%? Because of the taxes? Yeah, what's that?
Yeah, because the tax rate is 30%, so it's not 7%.
Exactly. The tax rate is 30%. So if you make a profit and then 30% of that goes to taxes, you get the other 70%, right? So what we have to do, take that after-tax amount, divide it by the 70% rate of what we get to keep. And that backs into that pre-tax number. So that's how you convert after-tax to pre-tax. Divide it by 1 minus the tax rate. 1 minus 0.3 would be 0.7. So that gives us our project profit, the first part of the formula. Any questions on that part? Okay, the next part, we have to figure out the project invested capital, right? That was the formula here. The investment, the project invested capital. So again, the way we're going to do this, we're going to take their total assets of 70 million, subtract the 22.8 million, which represents their current liabilities and the current assets they bought with those liabilities. And the result is what we're going to go with as our fixed assets. Now that's making an assumption, but that's all the information we have to work with. So total assets minus those current liabilities gives us an idea of what the fixed assets are. And that we're calling the invested capital. Okay, well now we've got the information we need to actually complete the formula. So the formula for residual income was we take the project profit, which we just said is $10 million before tax. We subtract from that the investment, which we just said is 47.2 million of assets, right? Fixed assets, times the 18% rate of return. And that gives us a result of 1,504,000. So that's our residual income. It is a positive number, so it's an acceptable option. But let's go over to the problem set and fill it in so that you can have a record of what we just discussed. Okay, so again, invested capital, we took the total assets minus the $22.8 billion of current liabilities. And that gave us $47,200,000. The project profit pre-tax, again, is your after-tax profit, 7 million, divided by 1 minus the tax rate, which comes out to 70%. And that gave us 10 million. And then once we actually do the formula, right, we take our project profit of 10 million minus our invested capital times 18%. We get a grand total sorry, forgot what to click on there. Grand total of 1,504,000. See why it took me a while to figure this one out? I don't think you necessarily need all these other numbers, but let's go ahead and put them in just in case. So let's see. So we know total assets was 70 million, right? And then the non-interest bearing current liabilities were 22.8 1.8 million. Might want to make a note of that just for reference. We know the after-tax profit was 7 million. 1 minus the tax rate came out to 0.7 for 70%. And when you multiply 18% times the invested capital, see what that came out to. That came out to 8,496,000. Okay. So I don't remember exactly what the problem set is going to ask you for in Canvas, but there's all the information that you might need. Any questions on this problem? Okay. All right, let's see what's next in the chapter then. Yes, EVA. So EVA is similar to residual income. Again, if it's a positive EVA, it's okay. If it's negative, don't do it. Now, EVA stands for economic value added. How much did this project add to your organization economically? EVA. Well, this formula, you'll notice, starts with after-tax income minus your invested capital, so similar to residual income, times the weighted average cost of capital. I think that's a new term. You might have seen it in financial accounting, but let's go ahead and talk about weighted average cost of capital. So I think you know that corporations tend to use a mixture of debt and equity. If you use too much debt, first of all, it gets expensive because you have to pay it back with interest. And banks might frown on that, and investors might frown on that. If you don't use any debt and you just keep selling stock, well, investors aren't going to like that either. Supply and demand. The more supply of stock you're creating, the less the value. Stock price goes down. So corporations typically use a combination of debt and equity. So to get your weighted average cost of capital, what you do is look at how much of your capital is coming from debt and how much from equity. For this company, they're getting 45% of their capital from debt, 55% from equity. What you then do is multiply that by the cost of that capital. So with debt, the cost is basically what you have to pay in interest. That's your annual cost for borrowing money, is the interest. Who can tell me what is the cost of capital with equity? If you issue stock, what is the cost? It's actually not really a cost. I guess it is and it isn't. It's what your investors expect your company to do in terms of performance. So if your investors are expecting 9.8% return, that's the cost of capital. So it's not money that it costs you, it's just that's what you have to achieve to keep those investors happy. So that's called the cost of capital for equity. So you would take these two costs of capital, multiply them by what percentage of your overall capital they are, the 45% and the 55% in this case, and that gives you a weighted cost of capital for debt, a weighted cost of capital for equity, and you add them together to get your weighted average cost of capital. Okay, it's not really that complicated. Mathematically, multiply one percentage by another percentage to get a percentage. You do that again, and then you add the two percentages to get another percentage. All right. Any questions? Okay, let's apply this EVA, economic value added measurement, to the donut division. Now, remember, it was the brownie division that wasn't doing so great, right? Donut division seemed to be doing better. Let's apply EVA and see if we still think that they're doing well. All right. So their profit is $250,000 before tax. If they're at a 40% tax rate, which doesn't exist, but if it did, that would be $100,000 of taxes. So their after-tax income would be $150,000, right? Then we have to subtract from that after-tax profit the investment, which is $1.5 million in this case, times the weighted average cost of capital of 9%. In this case, we get an EVA that's positive, it's $15,000. So that would be acceptable. Again, if it's negative, it's no good. Ooh, okay, this one's time consuming. But I guess we ought to do it. Okay. Yeah, I guess we just ought to do it. Okay. In this activity, we need to calculate sales margin if we buy a new machine and also if we don't buy a new machine. We also have to figure out asset turnover with and without the machine. ROI, again, with and without. Residual income with and without. EVA with and without. And then decide, after all that analysis, should we buy the new machine? And then there's another question. So I'll tell you what, we'll start on this. I don't know if we're going to finish it by break time. In fact, maybe what we'll do, if it's okay with you all, we could save this for Thursday, because then we can start fresh on it. It would also be a good review. And then just take our break a little early, like now, and then come back in 10 minutes and get an earlier start on the exercise set. Okay, let's just do that. So come back at 2:41.